Good afternoon, everyone. Thank you for joining our webinar this month on rental properties. As usual, we have Sophia Kim Sakamoto, our estate planning attorney, Yuri Yu, our CPA. Congratulations on wrapping up another tax year, by the way. 2020 was a rough one. So many tax changes, and some of them weren't even finalized until literally weeks before the tax deadline was due. So I'm sure you're glad to be done. And I'm Donna Lee, a financial advisor. All right. If you have any questions, please feel free to type them into the chat box. We will answer them at the end of the webinar, time permitting. And as a reminder, this presentation contains general information and not legal or tax advice. No attorney-client relationship or privilege is established by this presentation of information. And again, if you have any specific question, please contact the presenter after our webinar. We organize this presentation by active role and passive role in real estate. Keep in mind, these are not tax terms. Rather, it's literally the physical act of being active and hands-on on the day-to-day tasks like finding a tenant, signing a lease, paying bills, etc., versus actually being very passive and letting someone else handle those tasks. All right. So first off, the question is when you should consider investing in rental properties rather than marketable securities like stocks, bonds, and mutual funds. There's really two aspects to any type of investment. There's income, which is recurring revenue, and capital appreciation, what it'll actually be worth upon selling the investment. So let's take a look at income first. So we want to compare income, right, for real estate versus marketable securities, and we want to compare them apples to apples. So we'll convert income to yield. Yield is the percentage of recurring revenue divided by how much is at stake. So in real estate, if you're, let's say you're netting $300 a month after all expenses, and you can see some of those expenses are like the mortgage, HOA, property tax, insurance, there's a whole slew of expenses. But let's say you're netting $300 a month after all of those expenses, then the income would be $3,600 a year. And the amount at stake is equal to the equity in the property. So equity in the property is basically the difference between the fair market value of the property and your loan amount. Okay, so this part is kind of tricky because equity changes over time, whether it's just due to market fluctuations where the house is worth more or less, depending on, buy and sell markets, or just over time, paying down the mortgage, the loan amount decreases over time. For stocks, bonds, and mutual funds, the yield is simply just the annual dividends that you collect divided by however much you had initially invested. Okay, so going back to that example of renting out a property, let's say generating $3,600 a year. This is net, so after all the expenses. When your equity is $100,000, that means your yield is 3.6%. Okay, so that may or may not be a good investment because you can likely get that same type of yield in securities. And dividends in a brokerage account may be more consistent because you never have to worry about losing a tenant or not having somebody pay rent on time, and months go by without an income. Okay. Next, let's take a look at capital appreciation. If the property is located in a desirable up-and-coming location, you can argue that you're likely going to be able to sell the property in the future for a gain. Whereas selling the securities, stocks, bonds, or mutual funds, especially if it's in bonds, it may not provide as much of a pop at the end. And lastly, don't discount the benefit of simplicity. Securities is a boring yet simple investment, whereas having an investment property is much more complex compared to a securities account, as you will hear more from Yuri later on all the tax implications that come with it, and Sophia regarding what happens if a death occurs. Remember, lastly, if you're refinancing the property, recalculate that yield, as it'll likely increase the yield since you're decreasing the equity, the amount that's at stake. Okay. Sometimes you end up owning investment property when you never even made the decision to buy it. Sophia, what happens if I inherit a property, a rental property?
Thanks, Donna. And that's a really good question, and a question that I get quite frequently as I deal with people who have passed away. So usually what happens is mom and dad pass and children unexpectedly get this rental property. And what do they need to do? Well, first you have to understand how these assets are transferred. And when I say inheritance, it could be through a trust. Hopefully mom and dad had a living trust, they passed, and in the trust it says it goes to the kids. If they had this rental but they didn't have any planning, it was just in their names, they passed, it might have to go through the probate court process. Whether you have a will or not, if it's in their name, it would have to go through probate. The rental could also be in an LLC, so depending on who are the members or who owns that entity, maybe there was an ownership change there. There's also something called a transfer on death deed that by the deed itself, it says if so-and-so is not here, then it goes to, whoever they choose. So those are the ways that you can inherit a rental property or any property in general. But if you do get a rental, something that you should note is to get an appraisal as of the date of death. And this is for capital gains or valuation purposes. Now, of course, there are some talk regarding potential changes to the capital gains step up in basis. Yuri's going to talk about that a little bit later. But for now, you need to know what is the date of death value so that later, if you go to sell it, you can calculate the capital gains that way. So that's one of the first things I tell my clients to do when there's a death. Otherwise, you may have some lease agreements on there. It was between like parents and the tenants. You need to update that to the new owners. You'll probably have to change some bank accounts around. Maybe the property insurance needs to be updated to the new owners. And oftentimes there is no lease agreement, so maybe that means the new owners need to create one with the tenants. Next slide.
Actually, quick question, Sophia. How does someone go and get an appraisal done on their property? Usually it's done when they're buying a property or selling, so it's part of the whole real estate transaction. Do they just look in the yellow pages, or I just dated myself, Google an appraiser and have someone come out?
Yeah, that's a good question. I want to say there's three options that I would say. One is an appraiser. You can find them online. You can, if you know somebody, you can do it that way. You have to pay them some money. They do an appraisal for you. Second, you can get a broker's opinion of value. You may be able to contact a realtor that you know who they can do value what they think, but you have to have an exact date and an exact number. So they can't be like, between 5 and 600,000, it should be like a number. Plus those broker opinions of values are less formal. So not sure if the IRS will accept that. In a formal appraisal, they would. There's also something called probate referees. These are special appraisers that are appointed by the court. They're listed on the state controller's website by county. These are people that they do appraisals, but they are court certified, so they can also provide that appraisal for you. I recommend that if you have a kind of a sticky situation where their beneficiaries or heirs could be fighting over that, then you want to get a neutral person who's appointed by the court to provide that appraisal for you.
Oh, thank you. That makes more sense.
Okay, so also what you need to know is Proposition 19. This is a recent law that passed just in November, implemented in February. There's a lot of parts to it. I'm not going to talk about the transferring of the base year value. I'm really going to focus on this parent to child, grandparent to child exclusion for property taxes. So when you inherit a property, even a rental, even a residential property, any type of property, the county always wants to reassess the property to today's market value or date of death value. So, and likely the property taxes could increase if the value went up. Of course, when mom and dad pass, it goes to kids, there's a change in ownership. Before this proposition, if it was to a parent to a child, usually the property taxes would stay the same. Now with Prop 19, look at all these limitations. So mainly for residential, mom and dad had to be living there, and then kids have to be living there with some limitations. for the property taxes to stay the same. With a rental, likely no one lives there. You were probably renting it out to tenants. And if that's the case, then your property taxes will increase and get reassessed. So this is something that you need to know. If there's a death, there is a statute of limitations, a timeline for you to let the assessor know, so that if you can get an exclusion from this reassessment, you need to file that timely with the assessor. This is something that I took from the BOE website, just about the differences in the former law and the current law. Next slide. So then if you are purchasing a rental, and from the perspective of an estate planning attorney, how should it be titled? Well, I want you to know that there is a probate threshold of $166,000 and $166,250. This means that if you have property that's just in your name, so maybe you bought this rental and you only put your name on it, and something happens to you, if you didn't do any more planning and it's over 166,000, it will go through the probate court process. That's why it would be good to put not only a rental, but maybe your residence or any other type of property into a living trust. So that will avoid going to probate court if something happens to you or if you become incapacitated. Sometimes my clients hold property as tenants in common or joint tenancy with others. Really quickly, tenants in common is just when two people hold it, and if one person passes, it does not automatically go to the other. It'll go to their family or whoever they want in their trust or will. If you have joint tenancy, whoever's on that title, if one person passes, it'll go to whoever's remaining on that title. When you have tenants in common, be careful, because that probate threshold of 166 will apply to your share. A very common thing I've seen is, like, boyfriend and girlfriend, before they get married, they decide to invest in a property. So these are common issues that I see regarding that. You could also own a rental in an LLC. That means that a separate entity, an LLC, will own that property. Now, people usually do that for liability purposes. That means, you have tenants in there. What if they slip and fall? What if they die in there? What if somebody comes to visit them and they get injured? Well, of course, they're going to probably make a claim with their insurance. But if the insurance doesn't cover it, or if it's outside those policy limits, then you as the owner could be personally liable, and all your other assets could be exposed if you're found at fault. And that's why people have LLCs, to protect that liability. So anything happens in the home, it usually stays within the assets in the home. It's very hard to get past that LLC to your personal assets. On the other hand, say you got in a car accident, your liability is exposed personally, but you have assets in a rental. Well, that could be protected because that's separate, not part of your estate. So the first thing is you need to make sure that you are properly insured. You have the proper policy limits. You need to probably talk with your insurance agent to see if you're properly covered, if it's sufficient. And if not, you can increase those policy limits and get an umbrella insurance policy. Keep in mind, anytime you're dealing with LLCs, or even if it's like joint tenancy, anytime there's a change, always anticipate that there could be property tax reassessments. So that's always an issue anytime there's a death, anytime there's a change in a deed. Always keep that in mind. Okay, next.
Wow, so we should definitely purchase the property in an LLC is what I'm hearing, if I'm concerned about liability. What about for tax purposes? Are there any benefits to putting a rental property in an LLC, Yuri?
The answer is no. I get that question a lot. I mean, really, there are no tax benefits to owning a rental in an LLC. Your deductions are going to be the same. The way the income or the losses are treated is the same. So whether you have an LLC or not, do it for the liability protection, which is very important. And just make sure that when you do open that LLC, that you transfer the property into the LLC. You don't just create the LLC and then, not move anything into it. But having an LLC, it does come with its own tax and filing responsibilities. So there's multi-member LLCs, that is LLCs that have more than one owner. Those LLCs file an annual partnership tax return with the IRS and California. Then there's single member LLCs. These are LLCs owned by just one person, or if you're in a community property state like California, you know, if you're married, then if both spouses are owners of the LLC, it can still be considered a single member LLC. Single member LLCs don't have to file a tax return with the IRS, but they do need to file an annual return with California. It's the California Form 568. And all LLCs in California have to pay an annual $800 LLC tax. Your first $800 payment is due within a few months of organizing the LLC. And this is whether you have income or expenses or any activity at all. Pretty much as soon as you organize, you're going to have to pay that $800. So just make sure you're aware of that, because LLCs are really easy to create, but people aren't always aware that as soon as you organize, you owe California money. The other thing that LLCs have to file is a biannual statement of information with the California Secretary of State. It's a super easy filing that you can do online. It's only a $25 fee. The problem is that because it's biannual every other year, people just forget to do it. And when you forget, then you can be subject to a $250 late filing penalty. So it's just another one of those things you want to put on your calendar and remember to do every other year. If you are going to create an LLC for your property, make sure you organize the LLC in the state the property is located in. So let's say you organize an LLC in Delaware, but the property is in California. You, the owner, live in California. You manage it from California. You're still going to have to register that LLC in California and file and pay taxes in California. So you'll end up having to pay LLC taxes in both Delaware and California. And lastly, you just never want to own property in a corporation, because, you know, corporations just have their own set of rules. They're a bit more strict. So if, like, say you decide you want to take the property out of the corporation, you know, maybe you want to move into it or give it to your kids or something. As soon as you take that property out of the corporation, it's going to trigger tax. And so you'll have to recognize and pay tax on any appreciation on the property. Also, corporations don't get the benefit of lower capital gains tax rates, so it's possible the corporation will have to pay a higher tax rate if the property is ever sold. And that's why, just in general, you don't want to own any appreciating assets like property or investments or stocks inside of a corporation.
All right. So along, going through, next slide. Sometimes it's not going. There you go. All right. So along the same lines of not having corporations own a property, same with retirement accounts. Why? Because it becomes a humongous headache upon distribution. If you own real estate in your, say, IRA account, you will be subject to IRA rules. So IRA rules stipulate that at age 72, you will start to take out required minimum distributions, R&Ds. So at that point, you're going to have to withdraw a certain percentage from your IRA account every single year. Now, it's really easy to withdraw 3%, 5%, 7% on a stock, bond, mutual fund brokerage account. But how are you going to sell 4% of your rental property? So this can be a major challenge. Easy. Then I'll just sell it from my IRA and sell it to myself. Now I don't have to worry about IRA rules. No can do. The IRS has strict rules that prohibit self-dealing. So what it just means is you cannot sell assets from your IRA to yourself. It's basically going from one hand to another hand. They're not going to allow that. So how does rental income affect taxes then, Yuri?
Yeah, you know, rental income is just like any other income you receive. It's taxed at your ordinary tax rate. So you're taxed on the net rental income, which is rental income minus rental expenses. Rental income, pretty self-explanatory. All the rents that you receive is considered rental income. But I just listed here, you know, some of the typical expenses a rental might have. Advertising, mortgage interest, property taxes. You know, any expenses you have related to the property are deductible. specifically incidental repairs and maintenance. I say incidental because if you spend money to add on to the property or improve the property, then those expenses, they're not written off right away. They have to be depreciated. A basic definition of depreciation is when you have an asset that you write off over a certain number of years as determined by the IRS, because the useful life of that asset is beyond just 1 year. So like a dishwasher, it's an appliance that you can use over several years. So if you purchase a dishwasher for your rental property, instead of completely writing it off in the year you purchased it, you write it off or depreciate it over 5 years. Now, there's often laws passed that allow for faster depreciation on smaller priced items like furniture or appliances. And these laws, I mean, they literally change from year to year, but generally, you know, that's how depreciation works. So how do we calculate depreciation on the property itself? First, we have to determine what the basis is for depreciation purposes. The depreciable basis is the amount that you can use when calculating depreciation. So if you purchase the property as a rental, easy. The basis is the purchase price. If you lived in the property for a couple of years and now you're converting it to a rental, then the depreciable basis is the lesser of the purchase price of the property or the fair market value of the property on the date you converted it. So it's the lesser of the two. So if you bought the property for $500,000, now it's worth $800,000, and you're converting it, your depreciable basis is $500,000. If the property is inherited, so mom passes away, now you own it, your depreciable basis is the fair market value of the property on the date mom died. And this is the whole step up in basis you get when you inherit a property. And like Sophia said, you know, this is where an appraisal really comes in handy. You know, appraisals, you know, they're not too expensive, but they are really important to do when you inherit a property. And if you didn't know you were supposed to get one, or you forgot to get an appraisal done, and it's been a few years, you can also, you can always get a retroactive appraisal done as of a certain date. So once you figure out what your depreciable basis is, then you have to split that between the land and the improvements. Land is just the value of the land that the home is on. The improvements or the building portion is the value of the actual house. So there's a little picture here, and that's just taken from an Orange County property tax statement. But depending on where you live, the land and building value, like that allocation, can vary quite a lot. So I know I've seen some like older homes like in Newport Beach where the land value is like over $1 million and the home value is like $100,000. So for this particular house, the value is $494, $360 is allocated to land, $134 is allocated to the building. Land is never depreciated, so the $134 is what gets depreciated over 27.5 years. So this is an area where I probably see the most mistakes when people prepare their own returns. They either use the wrong depreciable basis, or they depreciate land when they're not supposed to, or they don't use the right number of years, or they just don't, you know, calculate any depreciation at all. So if you do prepare your return, you know, having a rental, that's usually one of those situations where I recommend using a CPA or a tax professional, just because it's an area that I see a lot of mistakes. And I will say that a lot of times when I do prepare someone's return who's used to doing their own and I find mistakes, a lot of the times it, what I find reduces the taxes they would have had to pay. So just something. Rental losses. Okay, so rental losses are a little bit different. Can you deduct rental losses? The answer is, it depends. Like so many answers to so many questions I get. Rental activities, they're subject to the passive activity rules with a few exceptions, you know, for real estate. Generally, passive losses can't be deducted on your tax return. Instead, they offset passive income. Like if you have income from a business that you're not like actively involved in, like through a K-1 or something like that. If you don't have any other passive income, then the losses are suspended or like put on hold, and they carry forward to offset future rental or other passive income. And those suspended losses are finally released and can be fully deducted when you sell the property. So this is something that, you know, sometimes comes to a shock to taxpayers. Like if you just started renting a property, you have all these expenses and it's not profitable, you're not going to be able to deduct those losses because of the passive activity rules. But there are two exceptions to the passive activity, passive loss limitations when you have a rental. One is the $25,000 special rule, which applies if you actively participate in the rental. Active participation is kind of a vague requirement, but generally, like Donna mentioned before, if you're the one managing the property, approving the tenants, collecting the rent, you know, you're actively involved in the day-to-day operations of the rental, then you're actively participating. So if you are, then you can deduct up to $25,000 of the rental loss on your tax return, as long as your modified adjusted gross income is under $100,000. Once it exceeds $100,000, then the loss is reduced until your income reaches $150,000, at which point you can't deduct any of the losses and they're suspended, subject to the passive loss limitations. And modified adjusted gross income is basically just the total income on your return before any deductions with a couple of adjustments. The other exception to the passive loss limitation rules is if you're a real estate professional. These rules are much more strict. So to qualify as a real estate professional, more than half of your working time has to be spent doing real estate activities, and it has to be more than 750 hours, which comes out to about 19 full-time 40-hour work weeks. And you can't count hours you performed as an employee unless you own more than 5% of the business. And real estate activities are, development of real property, construction, management, brokerage, things like that. There's a lot of cases of the IRS successfully going after people who claim to be real estate professionals. So if the IRS ever questions it, the burden is on you to prove that you are. So it's not a position to take lightly just to write off rental losses.
All right. Well, this one I get often. Since real estate is so expensive in California, it makes a lot of sense to purchase a rental property outside of the state. So what considerations do I need to keep in mind, or if there's anything I need to keep in mind, Sophia?
Well, Yuri can probably say about this part, but you do have to file other state tax returns. And the one thing to note is that make sure the property is in your trust or LLC to avoid probate in that state, because you can live in California, you could have property here, and you could have rentals in another state, but depending on their probate laws, if something happens to you, hopefully their probate laws are easier, but if not, your California trust could also own that property in another state.
All right. Yuri, what about now if I'm looking to sell my rental property, especially these days where the real estate market is high everywhere in the country? What are some things that I need to be aware of?
Yeah, when you sell a rental property, it's kind of like selling any other investment like stocks. If you held it for less than a year, it's taxed at your ordinary rate, which is the same rate your salary or your other income is taxed at. If you've owned it for more than a year, or if the property is inherited, then it's taxed at the lower capital gains tax rate, which ranges from 0 to 20%. On top of that, there's also the net investment income tax. That's the additional 3.8% tax on investment income. Yeah, and then to calculate the gain, you start with sales price, you add back any depreciation you took on the property, and then from there you just have a bunch of subtractions. You reduce it by the basis in the property, you reduce it by the cost of any improvements you've made to the property, you subtract any selling expenses you have, and basically what's left is the taxable gain. Now say your gain is $200,000, you've taken depreciation expense of $50,000 over the years, $50,000 of your gain is going to be subject to the depreciation recapture rules, and it's taxed at a slightly higher rate with the maximum rate of 25%. All of these taxes and calculations, they're all figured out on your tax return, but it's just something to keep in mind because sometimes people just think like, oh, I'm selling something, capital gains 15%, that's it. But there are other taxes that kind of come into play. And one thing I just wanted to quickly mention is that when you do sell a property in California, you're going to have to fill out this real estate withholding statement. And the escrow company is usually going to give this to you with a stack of other documents to fill out. Just something to keep in mind, if the house is your primary residence, you just check the first box and you're good. But if it's a rental or investment property, you might have to do some more calculations to minimize the amount of taxes they withhold from the sale. Okay, so section 121, nothing new, just real quick. If you sell a primary residence, you can exclude up to 250 or 500,000 of the gain if you own the home for at least 2 out of the last 5 years and use the home as your principal residence for at least 2 out of the last 5 years. It's 24 months and it doesn't have to be consecutive. So if it was your principal residence and then you converted it and then you sell it, you can still use the exclusion as long as you meet the ownership and use requirements. But what happens if the property was a rental first and you moved into it? The rules are totally different. You can't, if the property was a rental and then you moved into it and lived in it for 2 years, you won't be able to exclude all of the gain because you're going to have a period of non-qualified use. This non-qualified use rule kicks in if the property was not originally a primary residence. So this is just something else to kind of keep in mind. There used to be this loophole many years ago where you could just move into your rental, live in it for 2 years and exclude all this gain. But now there's rules to kind of prevent that from happening. And then just briefly wanted to mention 1031 exchanges. I'm sure you've heard of them, but it's a method to potentially defer the tax on the sale of investment property. 1031 exchanges, very complicated. They have a bunch of rules. So if this is something you're considering, I do strongly recommend consulting with your financial advisor and your CPA just to make sure this is the right decision for you. Anytime you're considering selling or gifting a property, it is worth it to consult with them just to make sure it's done in the most efficient way. And there's a lot more tax law changes coming this year. President Biden recently proposed his tax plan. They're going to be negotiating it. And there's definitely going to be something that passes before the end of the year. Some of the things being mentioned are, almost doubling the capital gains tax rates, limiting the step up in basis that so many of us use in our strategies. So we will be discussing these changes. We have a year-end planning webinar in November. So make sure to join us and we'll go over them then.
All right, so here now we just get to the passively investing in real estate. And again, what we mean is for the purposes of this presentation is having real estate, but not handling the day-to-day operations. So how do you not handle the day-to-day operations? Well, REITs are a good way to let a company do it all for you. REITs stand for Real Estate Investment Trust. It is basically a portfolio of buildings to invest in. It's usually not just you. These portfolios have buildings that are worth 100 million, 200 million, and for the average person, they don't have $100 million. So it is a portfolio of a bunch of different properties, and there's a lot of different investors that are all investing in the same REIT. Now, these REITs usually are in they're in institutional quality properties. So they can be a REIT for grocery stores or hospitals or Amazon distribution centers or Walmart distribution centers. So by owning a REIT, you have access to institutional quality properties, whereas normally you may not be able to buy a distribution center all on your own. Now, because you're not managing the day-to-day operations, you're not going to Amazon and collecting a check every single month, you're not fixing the toilet when it leaks, you're not even doing the bookkeeping involved with this property. It is very passive. You just invest it and leave it alone, and there's really not much work that needs to be done at all. Diversification is a big characteristic too, because with your let's say you're putting $100,000 into a REIT. Well, instead of buying one property, you can actually, you're getting access to, 20 different properties that are all in this REIT. Maybe little pieces of 20 hospitals now is what you own. And because it's very passive investment, it limits your personal liability. REITs can be traded on the stock exchange, or it could be not traded at all. So that's what traded versus non-traded means. Obviously, if it is traded, then there's a ticker symbol, you can log on and check, and you can sell it and buy it at any time. But if it's not traded, then there is definitely a liquidity risk, because you're going to have to wait until the REIT sells off all of their properties for you to be completely out of this investment. Now, please note that REITs, they are considered an alternative investment, and by nature has a lot more risk factors involved with this. If this is something that you're considering, definitely talk to a professional about this to make sure you understand the pros and cons and all the risks that are involved. Also, keep in mind that you must meet net worth and income requirements to be able to invest in these, because they are not suitable for everyone. DSTs are Delaware statutory trusts. They are similar to a REIT, but you're able to use this for a 1031 exchange. So we're not going to get too much into the weeds here in this presentation, just it's kind of outside the scope of our talk today. But if this is something that you're interested in, or you've heard about and you want to learn more and it may fit your situation, please talk to a financial professional, talk to a CPA and or a financial advisor to see if it meets your needs. Here's a chart that shows the various taxes that might affect your investment. Let's say you bought a rental property years ago. You bought it for $100,000, and now you're selling it for $1 million. The capital gain on this, if you have fully depreciated that property, is $1 million. Okay? But then you're going to have to subtract out all these taxes that Yuri was talking about. So you subtract out depreciation recapture, that 25% she referred to. You're going to have to subtract out federal long-term capital gains, 20%, state long-term capital gains. Now this is a 5.1% is a national average. Clearly in California here, it's like double that. And then there's a Medicare surcharge too as well. So when you subtract out all these different taxes, you're left with only $686,000 to invest into your next property. It's a lot less. Whereas if you 1031'd it, you would get all of those taxes that you would have to pay basically gets deferred. This wraps up our conversation. Does anyone have any questions? Or Yuri, Sophia, were there any questions?
No, there wasn't any questions, but if you do have questions after this webinar, feel free to contact each of us. All right, everyone. So thank you for joining us today for our webinar on rental properties. We know your time is precious, and we strive to provide content that is informative and useful. We will be taking a short break in June for the summer, so we will not have a June webinar. A short survey is going to be sent out to you by email. We would appreciate it if you would just give us some feedback, and here's our contact information here. But in July, we are going to be sharing a bit more about us and having a live Q&A session to discuss questions that you would like answered. Many of you have been through our webinars for this past year, and we're so grateful for your support. Some of you have asked about our background and how we got to where we are. So we're going to be discussing about our professional paths to today. This will be a good webinar to get to know us a little bit better. And also, if you know any high school or college age students who are curious to learn more about careers as a financial advisor, accountant, and attorney, this would be a good webinar as well. We also have the rest of the year scheduled for webinars. So for the month of August, September, and October, we're going to be starting a business series for business owners. In August, we're going to have a guest speaker, business attorney Garam Kang, to discuss entity formation, LLC versus corporation, and common mistakes business owners make when setting up a business and what to do about it. In September, we're going to have another guest speaker, Sanjay Sabharwal, to discuss legal issues facing business today, wage and hour, discrimination, harassment, maybe COVID changes in the law. And he will also talk about some day-to-day operations of a business. In October, we're going to be scheduling a TPA, a third-party administrator, Jeremy Yang, and he will talk about various retirement plans businesses can set up to maximize tax deductions. And finally, in November, we are going to be talking about year-end tax planning and summarizing all those tax changes and ways to plan for the end of the year. So be sure to register to get your Zoom link. And you can find all of our past webinars on YouTube. Thanks everyone for attending today. Have a great rest of your week.